Futures trading is the approach the million-dollar experiment uses for its income engine. We chose it for specific reasons, which we'll walk through in this episode. But it's not the right approach for everyone, and the purpose of this episode is not to sell you on the idea of futures. It's to give you a clear enough picture of what futures trading actually involves so that you can decide whether it's worth exploring for your own income engine. So let's start with the basics, because the word futures sounds more complicated than the concept actually is. A futures contract is an agreement between two parties to buy or sell a specific asset at a specific price on a specific future date. The original purpose of futures markets was practical. A farmer and a buyer could agree in advance on the price of a crop, locking in certainty for both sides before the harvest arrived. That practical origin is why the markets are called futures. They are contracts about what will happen in the future. In modern markets, most futures traders have no interest in the underlying asset. They're not planning to take delivery of barrels of oil or bushels of wheat. What they're doing is trading the contracts themselves, buying when they expect the price to rise and selling when they expect it to fall, capturing the difference between their entry price and their exit price. The underlying asset is just the reference point. The profit or loss comes from the price movement of the contract. For the income engine, the relevant futures markets are financial futures, contracts based on stock indexes or interest rates or other financial instruments rather than physical commodities. The million-dollar experiment uses micro, E-mini, S&P 500 futures, which are contracts based on the S&P 500 stock index. When the S&P 500 moves up or down, the value of these contracts moves accordingly. A trader who correctly anticipates the direction of that move, going long when they expect a rise and going short when they expect a fall, they tend to profit from the price difference between the entry and the exit. The key feature of futures that makes them particularly relevant for the income engine is leverage. When you trade a futures contract, you don't need to put up the full value of the underlying position. You deposit a margin amount, a fraction of the total position value, and then you control a much larger position with that smaller amount of capital. This is what allows the million-dollar experiment to generate meaningful monthly cash flow from a $3,000 starting account. A $3,000 account trading micro E-mini S&P 500 contracts can control a position worth significantly more than $3,000, which means the absolute dollar return from a successful trade is larger relative to the capital deployed than it would be in a direct equity trading account of the same size. This leverage works in both directions, though, which is an important thing to understand. It amplifies gains, but it also amplifies losses if a trade moves against you. And this is why risk management, specifically the limit on how much capital you risk per trade, is built into the income engine method as a non-negotiable foundation rather than as an optional consideration. In the million-dollar experiment's specific approach using MES futures, that limit is 2.5% of the account per trade. At a $3,000 account, that means $75 maximum risk on any single trade. The leverage creates the opportunity for meaningful returns at modest account sizes. The risk rule is what prevents that leverage from becoming dangerous. Now, understanding what futures are is one thing. Understanding what it actually feels like to run a futures-based income engine on a day-to-day basis is something different, and it's the more important thing to assess when you're deciding whether this approach is right for you. Futures trading is an active approach. It requires you to be present at your screen during a specific trading window, paying honest attention to what the market is doing and making real decisions based on what you see. This is not a background activity that you can run while doing other things. The market is moving, positions are developing, and the method your mentor teaches will have specific criteria for when to act and when to stay out. Applying those criteria correctly requires focused attention for the duration of your chosen session. Different traders choose different session windows depending on their schedule and on the instrument they trade. S&P 500 futures, for example, trade nearly around the clock, which gives investors in different time zones a meaningful choice of when to engage. You don't need to trade the New York Open if that falls in the middle of your workday. But whatever window you choose needs to be genuinely available, not theoretically available if everything goes well, but actually free of other demands that would pull your attention away at critical moments. Within futures trading, there's also a significant range of styles that differ in pace. At one end of that range is scalping. making many short-duration trades within a session, entering and exiting positions quickly to capture small moves. Scalping requires fast decision-making, a high tolerance for rapid sequence of small wins and losses, and the ability to stay disciplined over a large number of trades in a single session. Now, at the other end of the range are slower, more deliberate approaches, waiting for fewer but higher quality setups, and holding positions for longer moves. These approaches involve more patience and less intensity per session, though they require their own kind of discipline in waiting for the right conditions rather than forcing a trade. The $1 Million Experiments experience in finding its income engine mentor is highly relevant here. The first two mentors we trialed taught legitimate methods, but both were built around a scalping style that proved too fast and too intense for us to sustain comfortably. The third mentor taught a more deliberate approach, fewer setups, more considered entries, and that pace turned out to be a much better fit for how we wanted to operate the engine. The point is not that scalping is bad and slower approaches are good. The point is that the pace is a genuine dimension of it, and it's one that you can only discover through actually trialing the method rather than just reading about it. When you evaluate futures mentors, pay attention to the pace that their method requires and whether that pace matches how you naturally make decisions under pressure. The emotional dimension of futures trading is worth addressing as well. Trading with real money in a leveraged market generates real-time emotional pressure in a way that paper trading or conceptual study simply doesn't. The two most common psychological challenges are fear of loss, which of course is the discomfort of watching a position move against you and the temptation to exit early before the method's criteria say to, and FOMO, the fear of missing out on a move that sets up while you're not at your screen or that you passed on and then watched develop. Both of these forces push you toward deviating from your method, and deviation is what produces the worst outcomes over time. This is why finding a mentor who addresses the psychological dimension of trading directly and repeatedly, not just the mechanics of when to enter and when to set a stop, that's why it's so important for the income engine. The method is the easier part to teach. The discipline to follow it consistently under pressure is what takes time to develop. And a mentor who engages with that challenge openly is giving you something more valuable than additional setup patterns. The capital efficiency of futures is one of the approach's strongest advantages, particularly for investors who are starting with modest amounts. The $1 Million Experiments income engine begins with $3,000 and generates returns at a rate that would be very difficult to replicate through direct equity trading at that account size. Other income engine approaches typically require more starting capital to produce comparable absolute dollar returns, which matters in the early months of the system when the income engine is still building towards scale. If you're working with a smaller starting allocation for the income engine, futures is often the most viable path to generating meaningful monthly returns from that starting point. The scalability of futures is also worth understanding before you move on. As the income engine account grows, the position size scales cleanly and linearly. In the $1 Million Experiment, one contract is added for every additional $3,000 in the account. The monthly income target grows proportionally because it's always calculated as about 8.3% of the current pre-trade account balance, not as a fixed dollar amount that you manually revise. This linear relationship between account size and income generating capacity is a significant practical advantage. Many other trading and investing approaches become more complex to manage as the account grows. New decisions about diversification, position concentration, or instrument selection are required. But futures scales without introducing that additional complexity. Every approach suits some investors better than others. Being clear about who futures trading tends to work well for and who it tends not to work well for is more useful than a general statement that is simply a good approach. So let's be specific. Futures trading tends to suit investors who can carve out a consistent daily or near daily time window that's genuinely free of other obligations. The method requires presence, and presence requires availability. If your day is unpredictable, if calls, meetings, or family commitments regularly appear at short notice and could pull your attention away mid-session, a futures approach is going to be difficult to run well. It's not impossible to work around an unpredictable schedule, but it requires either choosing a session time that's protected or accepting that your consistency will be lower than the method generally requires to produce its best results. Futures trading also tends to suit investors who respond well to rule-based systems with clear and specific criteria. The best futures methods are not discretionary. They do not leave large amounts of judgment to the trader in the moment. They have defined conditions for when a setup exists and when it doesn't, defined risk limits, and defined exit criteria. Investors who are comfortable following a structured system, even when their instinct says something different, and who can maintain that discipline over many repetitions, well, they tend to develop well in a futures approach. Investors who find rule following constraining, or who prefer to exercise significant personal judgment in their decisions, they may find that the discipline requirements of futures trading are more difficult to sustain. The approach is also well suited to investors who are comfortable with the idea that short-term results will be mixed, and that the method is designed to produce positive outcomes over time rather than on every trade or every day. Futures trading involves regular losses, and not because the method's flawed, but because any directional trading method will be wrong some percentage of the time. An investor who can accept that individual losing trades are a normal part of the process, and who can evaluate their performance at the monthly or quarterly level rather than at the individual trade level, they'll tend to handle the emotional texture of futures trading more comfortably than one who experiences every loss as evidence that something's wrong. Futures trading is generally less well suited to investors with highly unpredictable schedules, as I mentioned, who cannot protect the trading window reliably. It's also less suited to investors who know from experience that they struggle significantly with the emotional pressure of financial decisions in real time, and who find that watching positions move against them generates anxiety that overrides their discipline. That response is very common among new traders, and it doesn't mean that a person can't develop futures trading skill over time, but it does mean that building that skill will require particular attention to the psychological discipline dimension, and that the early period of live trading may be more difficult than you may anticipate. If you have a lot of capital available for the income engine, and your schedule does not easily accommodate daily active trading, it's worth considering whether one of the other income engine approaches in episodes 19 or 20 might be a better fit. A larger account deployed in a less time-intensive approach can sometimes produce better real-world results than a highly efficient approach that the investor cannot sustain consistently due to schedule constraints. On the capital question, $3,000 is the practical minimum for running one MES, that's a micro E-mini S&P 500 futures contract, with the risk management that the $1 million experiment uses. And that's deliberately accessible. It was designed to be the smallest starting account that allows you to trade the instrument properly. Some futures instruments require more starting capital, and some require less. The key principle is that the starting amount needs to be large enough to apply the approach's risk rules without constraining your decisions, and not just large enough to place a trade. There is one more practical consideration worth naming here before we move on to the decision framework. Futures trading requires a margin-enabled brokerage account with access to the specific contracts you want to trade. And not all platforms support all futures instruments, and some platforms have minimum account requirements or nationality restrictions that affect access. So before you commit to futures as your income engine approach, verify that the platform you're planning to use supports the specific instrument and account type that you need. This is a practical step that's easy to verify in advance and potentially significant if it turns out your preferred platform doesn't support your chosen instrument. Now let's close with the practical question. Based on what you've heard in this episode, does futures trading seem like a realistic candidate for your income engine? There are 3 questions worth sitting with. The first one is whether you can commit to a consistent daily trading window. Not whether you could theoretically find time if everything aligned perfectly, but whether there's a session window in your current week that is genuinely and reliably available. If the answer is yes, if there's a defined time each day that you can protect, then the time dimension of futures trading is workable for you. The second question is whether the emotional texture of real-time trading, as we've described it, feels like something you can build toward. You don't need to be fully comfortable with it right now. I mean, nobody is comfortable with something they've never done. But if your gut reaction to the description of managing positions in real time, experiencing losses as part of the process, and maintaining discipline under pressure is one of recognition and acceptance rather than dread, well, that's a meaningful signal that the emotional demands of futures trading are within your range. The third question is whether the capital efficiency argument resonates with your situation. If you're planning to start the income engine with a relatively small or modest allocation, futures is one of the few approaches that can generate meaningful monthly returns from a small account through the leverage characteristics of the instrument. If capital is not a constraint and time is the binding factor, another approach might suit you better. If futures feels like a genuine candidate for your income engine, well, the next step is to go through the Module 2 process that we talked about earlier for finding and evaluating a mentor who teaches a futures method suited to your schedule and style. The resources page at theinvestingproject.com lists categories of guidance relevant to futures trading. Remember, the lesson from the $1 Million Experiment's own experience was that it took 3 mentor trials to find the right fit, and the mismatch in the first 2 trials was about pace and style rather than credibility. The 30-day trial process is particularly valuable for futures because the pace is something you can only really assess by experiencing it in practice. If futures does not feel like the right fit after hearing this episode, that's also a useful conclusion, and it's exactly why this module exists. The next 2 episodes cover the other income engine approaches. Episode 19 looks at active stock trading and options income trading, and episode 20 covers foreign exchange, penny stocks, and a few other approaches. There's a good chance that one of those alternatives will resonate more strongly with your situation. One thing worth carrying forward, regardless of which income engine approach you ultimately choose, is that the discipline principles that make futures trading work are not unique to futures. Every active income engine approach requires consistent presence, rule-based execution, sound risk management, and the psychological discipline to follow the method when it's not immediately rewarding. The specific mechanics differ by instrument, but the underlying requirements are similar. If you find yourself drawn to futures for its capital efficiency, but concerned about the pace, it's worth knowing that slower-paced futures methods do exist. If another approach interests you for its lower intensity, it's worth understanding that it still carries its own version of the same discipline requirements. The instrument changes, but the demands of running an income engine consistently don't. The goal at the end of episodes 18, 19, and 20 is to have a working hypothesis about which income engine approach you want to explore further. You don't need to have reached certainty. A clear direction is enough to begin the mentor search. If futures is still on the shortlist alongside other options after you've heard all 3 episodes, that's perfectly fine. The 30-day trial process is designed to help you make the final call through direct experience rather than through speculation. So remember to like and subscribe so you don't miss episode 19, and we'll see you there.